Thank you for joining us for this quarter's Observations in Global Equities and Fixed Income. My name is Adam Sparkman, and I'm a Client Portfolio Manager with Thornburg Investment Management. Today I'm joined by our co-heads of investment, Ben Kirby and Jeff Klingelhofer. Gentlemen, thanks so much for joining us. So Ben, maybe sticking with the topic of valuation differences, within value and income-oriented stocks, obviously they typically trade at a discount to their growth counterparts, but really since the pandemic, we've now seen that valuation spread really blow out to almost 50% today. If you look back historically to 2006, the dispersion in valuation has typically been 25 to 30%. So given this widening, what's your outlook for value and income stocks moving forward?
It's a great question. I agree with all of those assessments. And I think it sets a great starting place for, we think, a multi-year period of value outperformance. So think about the last decade. As Jeff alluded to, interest rates were near zero. Money was very available. We think the next 10 years will look a lot different. There's a real cost of capital today. Inflation is going to run at a somewhat higher rate, we think, in the next 10 years and in the last 10 years. And those are a couple catalysts for value stocks to perform a little bit better. This year, the MSCI World High Dividend Yield Index has only returned 3%. So whenever people think about a pretty good equity market in 2023, there's actually a part of the market that really has not kept up, and is these higher dividend paying companies. What I would add to that is, from this starting place in valuation, forward returns on market cap weighted indices is not likely to be very great over the next 10-year period. Again, valuation is not a great predictor of your next year's return, but it's a very good predictor of 10-year compound return. On that basis, we think that the next 10 years, stocks will probably return less per year than they have in the past. Starting with a higher dividend yield, if that's a strategy to pursue, we think is a great way to outperform the indices over that time period. If stocks are going to return 5 to 6% per year over the next 10 years, and you can start with companies paying a dividend of 3 to 5%, that's going to be a great head start to outperform over time.
Jeff, maybe turning to fixed income markets, the Fed last month kept its target rate unchanged as expected, but they still find themselves in a bit of a balancing act. On the one hand, signs of recession are still definitely flashing red, but on the other hand, inflation has come down dramatically from last year's high. From here, do you see the Fed raising rates one more time, or do you think they might keep things kind of steady from here unless we really see signs of a recession?
Yeah, I'll put myself on the record. I think that we get one more Fed rate hike. But I'll also put myself on the record in saying it doesn't matter. I think what we need to do is listen to the Federal Reserve. They've been asked this question many times. We talk about the Fed as having a dual mandate, maximum employment on one side, per your thoughts. Yes, we're starting to see some potential weakness, not directly in the employment market, but leading indicators to the employment market, the growth side of the equation. But they're clearly missing on the inflation side, and they've told us exceptionally clearly they will focus on getting inflation back towards trend at the cost of growth. Right? As they look out, as Ben has alluded to, over the long period of time, we have to have price stability before you can get growth stability and maximum employment. So long as we see inflation not returning to the 2% Fed target, I think that they'll be continue to push towards additional hikes. Now we have to balance that. We've talked a little bit about, right? We continue to see a recession coming, and I think the Fed does too. So at some point, they're happy to pause for a very prolonged period of time. But the last piece that I just want to continue to talk about and reassert is, I think the Fed is willing to tolerate above trend inflation, but it's the composition of that inflation that really matters. Predominantly where we've seen that stall is in the cost of labor, and most of that is coming from low-wage income earners. The Fed's more willing to tolerate that continued push and elevated inflation if it comes from compressing the wage gap. So they don't have to get back directly to 2%, which is their long-term objective, but even at today's levels of close to 4%, I think it's still too high for the Fed, and I do continue to expect at least one more hike from them.
Jeff, last time we discussed that really at its core, fixed income is an exercise in balance sheet investing. When investing, I know that you and your team consider really the three central balance sheets: government, corporate, and consumer. In a variety of ways, each is showing some signs of decay. Given this precarious environment, where are you seeing the best relative value opportunities across the fixed income landscape?
Yeah, I think for a long while we had really liked the consumer balance sheet. But in today's environment, we are seeing that deteriorate perhaps the most rapidly. It's a little bit of a tug-of-war between whether the consumer is deteriorating at a faster pace or the government balance sheet's deteriorating at a faster pace. But we continue to believe that the government balance sheets, certainly amongst the developed economies, aren't really a challenge. At this point in the cycle, what we want to do is focus on forward-looking metrics. We've talked about the boon of low interest rates. We think that's come to an end. It allowed consumers to significantly expand their balance sheet coming out of the GFC. It allowed them to pull a lot of demand forward. But as been alluded to, now they're feeling the pain of higher mortgage rates, higher financing costs across the board. Corporations are a little bit more of a balancing act in the sense that the very highest quality companies have actually seen an improvement in their balance sheets because they've got a lot of cash. So they've termed out their debt at very low levels, and the cash today is yielding 5.5% or even potentially 6%. But all of that too will catch up as they have to refinance. So I'd say mostly what we're focused on is a move from lower quality either companies or consumers into the higher quality space amongst both of those, more acyclically oriented, as well as what we want to do within the portfolios is we want to move that form of credit volatility under the shorter duration spectrum. And we want to focus on some of the longer interest rate volatility, things like US Treasuries and agency mortgages, as a ballast to some of that short credit volatility.